The sudden surge in gold prices to rupees 74,000 per 10 grams has caught everyone's attention. But what are the driving forces behind this sudden rise? And more importantly, should you consider adding gold to your investment portfolio? Is the current moment favorable for investing in gold? Let's dive into the factors behind this price surge and weigh the pros and cons of investing in gold. Welcome to holisticinvestment.in. The surge in gold price isn't solely driven by Indian consumers. There are more intricate factors at play. Despite a dip in global and Indian demand for gold, prices continue to climb. Let us look at those factors for the continuous surge. First, shifting from US securities. As the US anticipate lower inflation, investors are exploring other investment avenues. Countries like Japan and China, major holders of US debt, are diversifying their assets, leading to a surge in gold demand. Next, central banks' gold reserves. Central banks, including India's RBI, are ramping up their gold reserves. China notably increased its reserve by 16.1% between 2022 and 2024. This trend signifies a move away from the US dollar as the primary global reserve currency. Next, gold production challenges. Despite increased mining efforts, gold production hasn't kept up. From 3,300 metric tons in 2018-19, it dropped to 3,000 metric tons in 2023. This scarcity could drive up gold's value. Next, dollar's impact. A weaker dollar often elevates gold prices. Given the dollar's influence in the metal market, any depreciation makes gold investment more enticing, thus pushing prices higher. Next, inflation protection. Gold is a popular hedge against inflation. This belief prompts investors to buy gold during economic uncertainties, further propelling its prices upward. When considering gold as an investment, it is essential to weigh the pros and cons. Is gold a safe haven? Despite common beliefs, gold isn't always a secure investment. Its value can be as volatile as equities, leading to dramatic fluctuations. For instance, between 2012 and 2015, the price of 1 gram of 24 karat gold fell from 3,105 rupees to 2,634 rupees, only reaching its 2012 price again in 2018. This period also saw a 15% decline in gold prices with no returns for 6 consecutive years. Given these fluctuations and the potential for gold to remain stagnant for extended periods, it is clear that gold doesn't fit into the safe investment category like fixed deposits. Next, gold as an inflation hedge. While gold can act as a hedge against inflation, it doesn't guarantee returns that surpass inflation rates, potentially resulting in lower real returns over time. Next, price stability. There is a misconception that gold prices remain stable. Although it holds historical value, its prices can experience significant fluctuation. A long-term investment approach may help manage these fluctuations. While gold can offer diversification benefits, it is important to understand the risk involved. To have a deeper knowledge, read the blog Understanding the Risk of Gold Investment: Volatility versus Stability. Next, gold versus stock market. While both gold and stock market are subject to fluctuations, let's compare their returns over a 15-year period. If you had invested rupees 10,000 every month in gold from January 2009 to December 2023, the total investment of rupees 18 lakhs would have grown to 39.37 lakhs. This represents a growth rate of 9.77%, which might seem reasonable. A question arises here whether the return is proportionate to the risk taken. That is, the risk here is the price fluctuation. Now let's compare this with the investing in the Nifty index over the same period. Investing rupees 10,000 monthly in Nifty from 2009 to 2023 would have yielded an annual return of 13.98%. As a result, your 18 lakh investment would have grown to 52.61 lakhs, earning you an additional 13 lakhs compared to gold. Next scenario, what if you had invested in an active equity mutual fund like HDFC FlexiCap mutual fund during this period? Investing rupees 10,000 monthly in this mutual fund from 2009 to 2023 would have resulted in your 18 lakh investment growing to 69.85 lakhs. This translates to an annual return of 16.43%, earning you a whopping 30 lakh more than investing in gold. These figures show that despite price fluctuations, the stock market tends to outperform gold in terms of returns. Next, long-term investment. Gold's historical performance has been inconsistent, with periods of decline and stagnant returns. This indicates that while it is often considered as a safe haven, gold doesn't guarantee substantial or consistent returns over the long term. While gold may offer diversification benefits, investors should carefully consider its volatility and historical performance before deciding to invest. Here is the final part: investing in gold, making an informed decision. The aim here isn't to deter you from investing in gold, but to offer a balanced view. Gold presents opportunities alongside risk, much like any investment. It is crucial to understand these risks and make an informed decision. Is gold a suitable investment for you? Well, that depends on your investment goals, risk tolerance, and market outlook. Consulting a financial advisor before any investment is wise to ensure it fits your financial plan. Ultimately, the key lies in diversification and stay informed as with any investment. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.